Don't give up just yet. I know the market's been tough. It's been toying with our portfolios, with our emotions, been kicking us in the balls. Just like that ex who keeps messaging you just to ghost you once you reply. But the Fed is cornered. Money printing could be coming. And last time it happened, well, some lucky folks turned crypto into beachfront property. Two key things, EFFR and SOFR. And no, they're not some crypto projects promising 100x before the year end. These two are actually interest rates at the heart of the financial system. So what the hell is the EFFR? It stands for the effective federal funds rate. Think of it as the heartbeat of the US financial system, the rate at which banks lend money to each other overnight. Now, why would banks need to borrow from each other overnight? Simple. Banks are required by regulators to keep a certain amount of cash in reserve. Sometimes they end the day a little bit short on cash, you could say. So what do? Well, just like anyone else, when they are broke, they borrow from the next guy who has some extra cash on hand, the bigger banks, right? But unlike our credit card loans, this happens just overnight. And the interest they pay is the EFFR. When the Fed raises or lowers interest rates, this is what they're really targeting. It's the rate that ripples across the entire economy, from mortgages to credit cards to how much liquidity is even floating around in the damn system, okay? A low EFFR, a lower EFFR means that money is cheap and plentiful. Markets love that. A high EFFR means money is tight. Risk assets like crypto, of course, when that happens, take a hit. Now, let's talk about the SOFR, the Secured Overnight Financing Rate. If the EFFR is the heartbeat of the banking system, then the SOFR is the blood pressure. It tells you how tight or how relaxed the broader market feels. Here's the deal. SOFR tracks the cost of borrowing cash using US Treasuries as collateral. In simple terms, it's the rate the big players, the hedge funds, the asset managers, the corporations pay to borrow overnight when they hand over treasuries as safety deposit notes. So unlike the EFFR, which is mostly banks lending to each other without collateral, SOFR involves a wider range of financial institutions, and the loans, of course, are secured by real assets, US Treasuries. Here's where it starts getting really interesting. If you're still here, congratulations. I know it's a lot of financial plumbing stuff, but this is really interesting, really important, and it has a big impact on things, okay? So stick with me. SOFR doesn't necessarily follow the Fed's target rate. It's driven more by market sentiment, by how nervous or comfortable the financial system feels about liquidity. When markets are calm and cash is abundant, the SOFR usually sits below the EFFR. That's because lenders are happy to accept lower returns when lending against safe collateral. It's like lending money to your super rich uncle who forgot his wallet. You barely charge interest because you know he'll pay you back tomorrow. He even lets you borrow his Rolex just to impress the girls, right? But when stress hits and everybody starts scrambling for dollars, attitudes change. Cash becomes scarce. Even risk-free treasuries start to look a little less comforting. The rates move. Lenders demand more, pushing the SOFR above the EFFR. That spread acts like a financial seismograph. A negative spread signals stability, while a positive spread means markets are hoarding cash and trust is thinning. As of October 21st, the EFFR is sitting at 4.11%. The SOFR is at 4.23%, putting the spread at around 12 basis points or 0.12%. So not exactly panic mode, but enough to flash perhaps a yellow light over on the Fed's dashboard. I mean, Jerome Powell is going to be watching this. The central bank is definitely keeping a keen eye on what the heck is going on right now. And here's the deal. Okay, all the explanation stuff aside, we've seen this movie before. Back in September 2019, SOFR spiked from 2.43% to 5.25% overnight, while the EFFR edged up from 2.25% to 2.3%, a jump in the spread from roughly 18 basis points to nearly 300 basis points in one effing day. Corporate tax payments and a massive treasury settlement suddenly drained liquidity, forcing banks to scramble for cash until the Fed stepped in with the emergency repo operations to calm the storm. And in case the current spread widens and the SOFR goes up, it's not necessarily the end of the world. Quite the opposite, at least for us crypto investors. Serious people, guys. We're serious people. Look, if this starts playing out, it might push the Fed to actually switch the money printers on. Now, we know they're ending QT, which is quantitative tightening, but quantitative easing, where they start buying back from the market, that is a different conversation. We'll discuss that more in a bit. But before we get into that, guys, question for you. If you're trading these crypto markets, trading Bitcoin, Ethereum, Solana, are you going to keep settling for less? Or are you going to take control of your trading, move it to an exchange that's actually going to give you massive rewards? Well, FEMEX is the OG cryptocurrency exchange. They deliver what traders need: deep liquidity, global access, and respect for your privacy. It's available to anyone, anywhere. You might need a VPN in some cases. Link down below. And the offer on the table right now is outrageous. Make your first deposit of $5,000 or more, you get $1,000 cash back. $1,000 cash back? Who does that? That's nuts, man. And if that wasn't enough, this month, new and existing users who joined through the link right down here can unlock up to 1 Ethereum in rewards, which is, somewhere around $4,000 just at the current prices. So will you make the switch today to an exchange that's actually going to pay you to trade? Your capital deserves better. Sign up now, claim the deal while it lasts. It doesn't last much longer, by the way. Link down below. Okay, now let's look at the possibility of rate cuts. As you know, we just got a 0.25% rate cut last month, which honestly is a bit underwhelming. The market really is demanding more, and we'll probably get another rate cut in about a week's time when the Fed meets again. Now, unless you're the type who believes bigger isn't always better, of course, but as we always say, patience is key. Papa Powell hinted that quantitative tightening, the Fed's process of slowly shrinking its balance sheet to pull money out of the system, might be coming to an end soon. He didn't give a specific date, but he noted the Fed is approaching its goal of ample reserves for the banks. Powell also said the data we got right after the July meeting showed that the labor market, as we all know, I'm talking about extensively, has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance. Let me translate, okay? In other words, the Fed sees the labor market cooling just enough that the risk of inflation and recession is starting to balance, setting the stage for more rate cuts, which, by the way, the prediction markets are almost certain that we're going to have a rate cut in about 10 days when the next Fed meeting happens, and potentially another rate cut at the next Fed meeting. There's only 2 more meetings this year, so we should have another 50 basis points or 0.5% in cuts. And of course, that sets the stage for what no one really wants to talk about yet, which is quantitative easing, which is the money printers going burr. And if the macro plays out like that, then holy cow. One other indicator giving us a heads up that the Fed could start printing. And again, an end to QT does not guarantee a start of QE, just to make that clear. But gold, the original hedge against inflation, as you know, money printing erodes the dollar's value. Central banks and smart money know this. Did you really think it's the guy lining up for half an ounce at a local coin shop driving gold to all-time highs? Of course it's not. That's just a symptom of the mania. What has really been driving this, central banks around the world losing faith in the US dollar and US Treasury notes and an inflation of the dollar. So here's the bottom line. The Fed is cornered. Liquidity is tightening. The labor market is cooling. And the balance between inflation and recession is nudging them toward rate cuts, potentially even into quantitative easing sometime next year. When they fire the money printers up, not if, but when. It's not just dollars that move. Risk assets will catch fire too. Remember 2020 when the Fed launched QE after the Corona beer market meltdown? Well, Bitcoin went parabolic. Prices exploded and the early movers rode it all the way up. Fast forward to today, the setup is really similar. We just hope that we don't have to have a major crisis happen before we get any sort of massive liquidity stimulus into the market. But funding costs are creeping up, liquidity is tightening, and Powell is hinting that tightening may end soon. We are in the Goldilocks zone. Everything's lining up. Interest rates are being cut. QT is coming to an end. Okay, central banks more broadly around the world are cutting rates or even easing themselves. This time there's regulatory clarity, institutional interest that we're missing years ago for crypto. I know the market has been in the shit recently, and there's never a guarantee in markets. That's investing, right? But it looks like the stage is set for another mega move here for the cryptocurrency markets. At least one more parabolic move before the next cycle kicks in, maybe even a couple. but that's for later us to think about. So if you're the type who likes to stay ahead of the money printers, now's the moment to pay attention, because history might not repeat, but man, it sure does often rhyme. And last time the Fed hit the QE button, the crypto degenerates were ready. Even the interest rate cuts, we don't even need QE, just cutting interest rates in of itself is going to make things go crazy. Thanks for watching.